Hello traders, Corey Mitchell here with TradeThatSwing.com, and today I want to talk about risk-reward ratios and how tiny changes in your entries, your profit targets, your stop loss will affect your risk-reward. And this is one of those details. If you want to be a consistently profitable trader, you really need to be aware of this, because I don't think most people are aware of how quickly your risk rewards deteriorate when you have poor entries or you're getting in a little bit later. I think a lot of people they look at a chart and they think this thing's going up, so I'm going to buy it. It doesn't really matter where I buy it. I'll just put my stop loss here. And that may work on one trade, but when as traders we're taking many trades, over the course of those many trades, we need to be able to keep our risk reward and our win rate up. Otherwise, at least at a certain level, to maintain profitability. And if we don't, it's very easy for those statistics to deteriorate. And a lot of people don't quite understand how that works. So this video, I just want to show you how quickly risk rewards can deteriorate or increase in your favor. And we'll look at entries, stop losses, profit targets, how to sort of establish these things, how we can figure it all out before we even take a trade. So on this side, I have a 1 minute chart for day trading. It's the same concepts. And over here, I have a daily chart for swing trading. For the swing trading example, it's as I'm recording this, it hasn't been great trading conditions for going long, so I just went back to a prior trade from last year when conditions were good, and we'll use that as an example. And the day trading example is actually from today, a trade I took. So we'll look at these and I'll show you how I kind of analyze them and just show you how some things kind of work. So before we even get into anything, let's just look at this trade. So the way I've set it up, I picked a 30% profit target. I'll show you why. And this entry point and this stop loss just below this candle. And ultimately this gives a 6.3 to 1 reward to risk. I'm risking 4.75%. This is price movement to make 30%. But let's say someone's not quite as confident in my setups, so they wait a little bit and say, okay, well, I'm going to get in up here. I missed my original entry point, but I feel much safer now that the price is already moving up. Look at how quickly that risk reward deteriorated to 2 to 1 just by waiting a little bit, because it's a double whammy. Now you're getting in closer to your eventual target, or even if you don't know where the high of a move is going to be, ultimately that price is only going to move so far, and now you're entering closer to it by waiting. And the second part is that your risk has dramatically increased. So before I was only risking 4.75%, meaning my stop loss was 4.75% away from my entry. Now it's up to 10. Or maybe someone waits till the daily close. That's a common thing. And basically, even if you magically knew where the high of this move was and you were getting out close to it, you've reduced your reward to risk to 1.3 to 1, even on a great trade. So just buying something because you think it's going to go up, that is not trading. Trading is these tiny details and realizing that the pro is making 6 times what they risked on that trade, whereas the amateur is only making maybe 1, maybe 2 times what they risked. And over many trades, that's just going to kill you. The pro has so much more leeway in the sense that if you make 6 times what you risk on a winning trade, if you have a couple losers, you don't really care. Whereas the amateur is sweating out every loss, because even if they win something, it barely makes back anything that they've lost. And this is why, because they're just getting into moves later. Or maybe they picked the right entry and they're getting in where they're supposed to, but they're so afraid to lose that they put their stop loss way down here. you've just destroyed your risk reward again. You're down to 1.3 to 1. Even if you get a massive move, the price moved 30% in your favor, but because you were afraid to lose and put your stop loss super far away, you're just destroying your reward to risk. You're down to 2 to 1, whereas I'm going to make 6 to 1 on this trade, something like that. So let's dissect this a little bit. Why did I pick 30 to 1 in the first place? And I'll usually, 30% in the first place. I'll look at how prices move. And so this little tool, you can always use it. It's in TradingView. It's called a long short position. You can just play around with it so you can see how drastically and very quickly reward to risk gets brutal as you get in later, or your stop loss gets bigger. Okay, so that's the one tool. But we can also use this measuring tool, or they just have a measuring tool. You can measure price waves. So you can see I like to get in once the price starts moving above prior candle highs. We have an overall uptrend. This was a rounded bottom type pattern. We made a higher swing high here, so this shows me prices starting to shift back up after this little downtrending period. And once that happens, I'm waiting for the next pullback. And the first sign that the price is starting to move higher is when we move above a candle high. So these candles, lower high, and then this one moves above the prior candle. So on this day, even when it starts looking like this, I can already put out an order, not knowing what's going to happen the next day, but just telling myself, if the price moves above that candle, I want to get long. I'll also sometimes wait for a consolidation. That's like 2, 3, 4 candles that move sideways, and it's the same concept. Once the price moves above the high of that consolidation, I can put my order out there in advance. I don't need to actually see it happen. Just say, if it's this type of setup and the price is moving sideways for a few days, once the price moves above the high of that consolidation, I'll have my order already sitting there and a stop loss below the low of the consolidation. That's also why I like to use daily charts, so that I only have to check them at night. I can put out my orders at night. Once I see this candle, I know I can put it out. So that's a little bit on some of the entry points I use. But let's look at why I chose 30% for this one. Let's measure out some price waves. So let's just start over here. This move starts here, goes up a little bit, and then kind of fails. So let's look at this one. So this one, same exact kind of, see this little drop, and then the first time it moves above a candle high, that's the trigger. Another one happened here, another one happened here, another one happened here. So this one starts going up, but our first entry point would be here, right? Because that's the first time. If we'd put out an order above here, we either wouldn't have got filled or we would have got filled at this open. So let's just measure that. So about 31, 32%, doesn't have to be exact. And then let's do this one. This one I don't like as much because it involves an earnings announcement. So that's like a little extra fuel on the fire. But that one ran 68%, but that's an asterisk because I don't generally hold swing trades through earnings. So I don't want to hold the trade I'm going to take, which is now happening over here. So again, I wouldn't have actually been maybe taking these trades, but now that we're over here and I'm analyzing this stock, I can look at how it's moved in the past to help me determine how I'm going to set my profit target for this. And then this one, same thing. We would have gone long right when it made its first new candle high after the pullback. That's about 37%. So then we start this downtrending period. Obviously, the price did not run after these little pops here. So I'm looking at these things and saying, okay, if I see a setup that I trade, which generally occurs when the price is going to make a run, how long have prior runs gone for? So at this point, I can say, okay, we've had 31%, 37%, 68% asterisks. A reasonable target would be 30%. That might be a little high. 25% would probably be a more conservative estimate, but on this one, yeah, I chose the 30. And yeah, it took a little bit of time. It wasn't as quick as these, but it was a reasonable estimate based on how the stock had been moving. So that's why I picked the 30%. So that established my profit target. Then, once the setup form, the rounded bottom. Then, we're waiting for all the conditions to kind of align. And yeah, so I could see, okay, this is a pretty small candle. I'm only going to be risking, that's basically my stop loss size, is that candle. So you could measure that candle out, see it's about 4.5%. And if you enter just above it, you're risking 4.5% to make 30%. So that's just a go for it type trade all the time, at least for me. But what would have happened if, this was a much bigger candle? Let's say, it dropped way down here. Now, my stop loss is going to go below that low of that candle, and I'm going to enter above. That changes things quite a bit, doesn't it? Now all of a sudden my stop loss is way down there because that was the low of that candle. Shows you how volatile the stock is. And that reduces my risk reward, right? I can still only go for about 30%. That's about how much the price is running before it enters a deeper pullback like what we saw in these last ones. So I can't go for much more than 30%. And my stop loss is much bigger now, so it's down to 2.3 to 1. Do I want to take that trade? No. If there's absolutely nothing else in the market, maybe I do. If that's the only trade I can find, then maybe I do. But if it's the only trade I can find, that might be a bit of a warning sign that conditions aren't good. When conditions are good, there's usually lots of good trading opportunities. So I'm probably going to go and find the trade that looks more like this, where I can have the stop loss like this and 6 to 1. Because again, it just goes back to, I can be wrong on this 3 times, 4 times, 5 times, and be right only once and still make money. Whereas if I take trades like that one I was just talking about, where my stop loss does have to be down there because we had like big, crazy, ugly candle, or I'm just getting in way too late because I'm lazy and I don't want to put all my orders before the market opens, and I end up getting in there, you're down to 2 to 1 reward to risk. Now, if you lose 2 trades and win 1, you're just at break even. Whereas with the other type of trade setups, you're up a whole bunch of money, even though you had 3, 4 losses and only won 1. So that's basically how that works. Let's look at a day trading example. I do day trade and swing trade a little bit differently. With the daily chart, I find you can find these pockets of really good risk reward. You do occasionally get them with day trading too. We'll discuss that a little bit. But you can get these little pullbacks with small stop losses and these big runs just because new people are kind of coming in every day. With day trading, I find momentum stalls and reverses a little bit quicker because you only have so many new traders coming in every minute. With the daily chart, you kind of have a new collection of buyers coming in that read news the night before or whatever. But in day trading, it's not like you just have a whole group of new traders coming in every minute analyzing the 1 minute chart. So I tend to stick to a 2 to 1 reward to risk in stocks of whatever my risk is, and in Forex 2 to 1 or 2.5 to 1. And that's, you'll occasionally find trades where we can really try to stretch that out, but for the most part I found 2 to 1 works really well for me, and that's kind of optimized in the sense that getting out at 2 to 1 is often kind of where the price is going to start to reverse anyway. So a little bit different mentality, and be aware of the market you're trading. You can generally not just take a concept from swing trading and directly plant it into day trading. Sometimes it works, but not always. So be aware, it's slightly different concepts here. But for the day traders, let's look at this example. So same thing. I'm going to measure out just kind of, we had a little uptick at the start of the day and then a big drop down to the bottom of this move where we got our first pullback. So 3.86%, huge move. This is a volatile stock. What I like to trade, just because they're highly efficient, you can put in a lot of capital and make 1, 2, 3% on your money very quickly. Whereas if you're trading SPY or something like that, the price is only moving 0.01% every minute or 2 minutes, and maybe 0.1% over 20 minutes. So if you put in a whole bunch of money and you catch a nice move, the most you're making is 0.2%, 0.3%, maybe a percent or two if you hold it all day. Whereas in a stock like this, yeah, you're exposing yourself to some risk, but you're also, if you know what you're doing, you're making 1.5% in 2 minutes on however much money you put into this trade. So that's why I like the volatile stocks. So again, let's get back to this. Almost the exact same setup we were talking about over here. This setup right here. Strong move, pull back, snaps higher. Pulls higher, boom higher, pulls back, snaps higher. Big drop, pulls back. So we're entering when the price drops below the low of this candle, and the stop loss is going to go just above the high of that candle. You can also put it above, the high of the whole pullback if there's multiple bars, but I'm usually opting for the smallest stop loss I can get for the reasons we've just been talking about. So on this trade, actually, let's just talk about how it went today, and not sure if it had actually, I'm pretty sure it had dipped a little bit below and then must have just popped back for a second, because I actually got in right at the low of that candle. So you can see here, ended up risking 8 cents or 0.76% on the trade. 2-to-1 target goes out, and that means I'm targeting 16 cents lower than my entry point, 2 times my risk, or 1.52%. And that's how that one played out. In a typical scenario, I'd be entering 1 cent below. And, sometimes you will get a little bit of slippage. And, yeah, so that's going to increase my risk a little bit. Now my stop loss is 9 cents, 0.875%. And to get 2-to-1, my target has to go lower now, just because my stop loss is that much bigger. People also, if you ever wonder why I don't include stocks under $5 on the best day trading stocks list, that's why. Because even at $10, 1 cent, is about 0.1%. At a $5 stock, 1 cent of slippage equates to 0.2%, which is just, increasing. You go from what you think is a 3 cent stop loss, and you get a cent or two of slippage, and all of a sudden you're at 5 cents. It accumulates extremely quickly. Like 1 cent begins to matter a lot, whereas over $10, it doesn't matter quite as much. At $100, 1 cent matters, it doesn't matter at all. So the lower price you go, the more 1 cent matters, and the more precise you have to be. And a lot of newbies really like penny stocks, yet because they see the big gains. Ooh, I make 1 cent. The stock's 1 cent. If it goes up a cent, I make 100%. But they also don't realize how precise you have to be, because if you mess up by 1 cent, you just lost a boatload of money. So that's why I don't include the really low price stocks. Anyway, so this scenario, same thing. So if someone got in a lot later, like down here, we can't just keep extending out our profit target indefinitely thinking the market will hit it, because the worse your entry point gets, the further that target has to get to keep your risk reward at 2-to-1, which is kind of what I want at least. And trades don't always go, like I use trailing stop losses and I get out early sometimes, but we kind of want, when we go into that trade, for everything to look like it could hit our target with a high degree of probability. But once we start doing this, getting really bad entries, or maybe our entry is good, but we just give the trade too much room because we're afraid to lose. We say, we're going to give this one so much room. Again, that's just going to keep extending out the profit target, which makes it less likely to get hit. So you're going to kill your win rate, and you're also going to kill your risk reward, because almost all of these, you're either going to have to get out early because the price didn't hit your profit target, or you are just going to end up losing and the price is going to hit your profit target eventually. So I'd much rather keep the stop loss as small as I can, which then also means my profit target is small, but I'm still going to make 2 times whatever I'm risking on my trade. So this was one, this had dropped 4%, almost 3.8%. So if we use that as kind of a gauge, we could maybe say, okay, well, the next drop could be 2%, maybe even 3%. So this was one I maybe could have gone for a little bit more. Like the bottom of the move was about 1.7% from the bottom of that candle. But, ultimately it didn't end up going. That's why I like just 2 to 1. Like I said, day trading stocks tend to reverse pretty quickly in the early hours of the day, even though we do get these big moves. But if you just got a big 10% drop and then had a tiny little candle here, maybe that's a time, we say, okay, like maybe let's go for a little bit of a home run here and put our target 5% away. And if we're only risking 0.5% or 1% on that trade in terms of the difference between our entry point and our stop loss, then, we could potentially get a 4-hour trade or a 3-hour trade or a 4 or 5-hour trade, something like that. But that would be a pretty isolated scenario where we're just seeing huge amounts of movement and we get a very tiny stop loss. If we're kind of around that 1% stop loss mark, I prefer to, keep that target at around 2% or less, just because I find those are more likely to get hit. So this would apply to whatever stocks you're trading. You have to look at how much it is moving. So again, if you're trading SPY, your percentage movements are going to be much smaller. The cent movements are going to be bigger because SPY, I don't know what it's trading at, $300-$400. Probably even more now. I don't know. I don't watch SPY very much. But so it's good. Your dollars and percentages are going to be a little bit different, but the concepts are the same. You still have to look at how much the price is typically moving. Can your target likely be hit based on those movements? And then are you getting in at decent entry points to allow you to have a good risk reward for that movement the market's giving you? So you can go through your trades. I recommend taking screenshots of every single trade, every single day that you day trade, or all of your swing trades, and then you can just flip through them and see, am I risking too much? Like if my stop loss is way up here, why? Does the price ever get back there? And then you can kind of crunch some numbers and say, okay, well, yeah, my stop loss is really big, but if the price reverses, it's hitting a small stop loss or a big stop loss either way. So how much better off am I using the smaller stop loss, which would then mean a better risk reward? And you can kind of go through all your charts and run numbers. And my guess is that most likely you're getting worse entries than you need to. Maybe you're using too big of a stop loss, or you're using too big of profit targets which just aren't justified for the movement, but your risk reward might not still be good. And I think people confuse that too. They think, well, I'm aiming for 30% on this trade, but if your stop loss is 15 or 20%, that's horrible. Like, even though you're making 30%, if you're willing to risk that much to make it over many trades, you're going to end up losing money. So just because your profit target seems big, you really have to think about it in risk-reward terms, but you also want to think about it is that profit target likely to get hit based on normal movement. So a lot to digest there, and ended up being a little bit longer video than I wanted, but hopefully it gives you something to think about, something to go through your charts and refine your trading, because if you can get this, you will have uncovered, for yourself at least, a major problem for most people that they're completely oblivious to, and I think is really the secret to being a consistently profitable trader, is these tiny details and just realizing how quickly that deteriorates. Even a little bit of a delayed entry or taking a little bit extra on the stop loss. One quick story before I finish. When I was at the trading firm for many years, they'd have new trainers come in, and sometimes they'd end up sitting beside you and they'd try to mimic you. And it was fascinating to me that they'd be taking the exact same trades But because, I'm taking a trade and then they're taking the trade and then I'm getting out and then they're getting out, I'd be profitable, they wouldn't be. Why? Because they're just getting in a little bit later, and then their exit's just a little bit worse. And that is the difference between profitability and being unprofitable. It's a very thin line. You're either getting a great entry, or you have to be willing to just say, "Oh, I'm going to wait for the next one." Because as soon as you start going down that road of, yeah, I missed my entry point, but I'm still going to take it, you've just pretty much destroyed your reward to risk, unless you can get in at that exact point where you're going to get in, the original entry point of the strategy. We can't deviate too far away from that, or you just start to destroy your reward to risk. So, stuff to think about. Until next time, happy trading.